There are a number of statistics that are quite frankly staggering. Look at the trucking industry, the shipping industries, air and sea shipping, all contracting. What about manufacturing? Sinking like a stone. But look at the media. Look at the stock market. Everything is fine, bro. Chill out. For me, I'd prefer reality. This is an absolute joke. People are so stuck in a sense of normalcy bias that they believe that their paradigm will never shift. So delusional, so numb. There, little sheep, go back to sleep. You came here for the truth, so let me unveil that for you. Today we're going to look at the truth. That's why you're here. I know that if you watch this channel, if you are a subscriber, you want the data, you want the real information. I'm going to give it to you right away. Let's begin. I wanted to lead this video in with this article because it just sets the tone for the remainder here. Asia markets rise in morning trade as Chinese exports unexpectedly decline. Now you might read that and think, wait a second, did I read that right? Well, look at the very bottom, the last point on this page. It explains what you need to know. The data miss now raises expectations that Beijing may introduce more stimulus measures to prop up its economy. So all of this bad news that we have been hearing out there, it's actually good because that means quantitative easing is coming back with a vengeance. This is all they care about because to the market, they associate quantitative easing with increasing asset prices. But you have to look at it multiple levels deeper. Number one, we see that historically, when you go back, let's say 2007, leading up into the crisis, we saw quantitative easing, we saw the reduction of interest rates take place over a number of years. As a result, we saw that stocks increased, the housing eventually started to increase, and so on. So when you see it on that level, a new round of quantitative easing means that we are going to see asset prices rise. Let's take it a level deeper. We are witnessing right now a devaluation of the currency. Most people can't figure that one out. I'm not even sure they care too much, but essentially what's happening is we are finding that it costs more to buy the same thing that it did last year and the year before and the year before that. Now you might find one share of Amazon costs more, but also a home costs more, also your produce costs more, and so on and so on and so on. Everything is becoming more expensive. Now some people would say, well, you know what, that's inflation, that's normal. Actually, inflation isn't normal, but that's what central banks love to do. Your wages inflate, that's true. However, they inflate at such a minuscule level. And then when you include the fact that the inflation rate, the real level of inflation, is nowhere near what actual wages are increasing at. But you look at the things that you have to buy, your electricity and your tuition and everything else that comes along with this that has gone up so incredibly high over the last decades, it is very clear to me that something doesn't add up. Now, I know that's a rant, but that's how I wanted to set up the rest of the video. So let's look at the probability of US recession predicted by Treasury spread. When I show you the data here at the Money GPS, I don't learn this information from some random website, give you that, and hope that the data is accurate. If there are any instances in which I'm giving this from what I would call a third-party source, I'm going to mention that to you and say, look, this is unconfirmed, but this is what I have for you. This case here, just like so many others, I'm grabbing this directly from the New York Fed's own website. It doesn't take much. Do a search online and you will find this for yourself. This information, the newest that they have available, is from September 4th, 2019, and you can see right here that it is at 37.9%. Essentially, we are at 38%. The last time we were here, it was leading up to the financial crisis. And you might think to yourself, 38%, not very high, but you have to look at it historically. It isn't really going to be there right at the very top drop 100%. That's not the way it works. So just look at this here and for a second understand that when we get to the levels at which we had been in the previous two instances, I mean, just look at this. Basically at this level of 38, the recession was basically on. Look at it in the previous 2001. It was already on by the time it got to this level. And then you look back in the 90s and you will see that we didn't even have to get to that point for it to be a recession. Time and time again, this occurs. Okay, so I just wanted to show you these repeating patterns and the fact that you do not come back from this. Okay, this is the way it works. We get to these levels and we cannot pull back. It just doesn't work like that. There is no mid-cycle adjustment, and they are very, very arrogant when they come in front of people speaking the way that they do, talking about how they can manipulate this, how they can prolong this. Meanwhile, they're the ones that created the problem in the first place. They are the reason everything happens. Federal Reserve Chairman Jerome Powell said Friday afternoon that the most recent monthly gauge of the U.S. labor market fit into an overall picture of healthy jobs market and economy. Now you tell me for a second, why in the world do we see this type of information put out there into the public, and yet they are decreasing interest rates? Still don't have a good answer for that. In fact, Powell said that the central bank is, quote, not forecasting or expecting a recession. Hang on to that thought for just a sec. We'll go into it. Incoming data for the US suggests that the most likely outlook for the US is still moderate growth, a strong labor market, and inflation continuing to move back up. All of this would present a clear picture that the markets, that the economy, they're both relatively healthy, and so as far as I'm concerned, there's no reason to decrease interest rates. Maybe you wouldn't increase interest rates, you wouldn't want to add more tensions, but there really doesn't seem to be a need to actually cut. You would stay at this level. Even people from the Federal Reserve have said this is where we should be at. We're good here. We're at that neutral level and things are fine the way they are. We're seeing things moving along. There's no need to actually decrease interest rates, but that's not what's happening. Northman Trader, we are forecasting a recession, has said no Fed chair ever. And he's making a point about what I just quoted to you. He's talking about how the Federal Reserve is never going to tell you that a recession is coming. 12 months after the fact, they're going to tell you that there was some events that occurred that led up to the point we're at, but you don't have to worry because we are actively involved and we are going to fix it. Now think about how crazy that is, that you're going to really put all your trust into this institution that is completely and entirely opaque. There is no transparency whatsoever. The Treasury, the Congress, they don't have any insight into what's happening, and all you hear is the Federal Reserve saying we need our independence, we need our independence. They're talking about something else. They're talking about actively doing things in the market and not letting anybody know. Now you might think, well, I don't really care as long as they keep my 7 shares of Amazon at a certain level, don't let it fall. But this doesn't happen. In fact, if you look at what occurs throughout the cycles, people say, well, you know what? Hey, if my stocks drop by a certain amount, 50%, let's say, I'm okay with that because they've already gone up 100% or 200% or what have you. Well, of course, 50% of the level that they peak out at is a severe drop. But look at individual stocks. Don't look at the market as a whole in this case. When you look at those individual stocks, they may drop by 70%, let's say. If we look at a lot of them, especially those growth stocks, they really hemorrhage during these periods. They go more than the average in many cases. So do your research and understand why you cannot trust an institution like the Federal Reserve, like any of the central banks. Take a look at the third quarter 2019 growth. You're seeing the S&P 500 earnings growth. This is not very good for many of these sectors. The energy sector, the IT sector, the materials, the S&P 500 as a whole. You can see all of this is looking very dismal. But on the other end, we're seeing utilities, real estate, healthcare, and some others that are doing a little bit better. There's no question about it. We're going to talk about the unemployment rate. I have two charts to show you. This is something that I have done, multiple times, but just wanted to give you an idea because it happens to correlate with the chart I showed you previously. Every single time we encounter the exact same thing. We have unemployment rate moving down, although there are certain instances up and down, but the general trend is down, down, down. Then out of nowhere, unemployment rate starts to tick up and a recession happens almost immediately. This is the last thing that occurs, okay? This is the very last thing. We get unemployment rate moving down, 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 down. Everything is good. Everything is great. Everything is fantastic. And then suddenly it's not. Look at it over and over and over and over again. It happens every single time. There is no question about it. But people somehow, it's odd, but they deny it. Look at this chart and it tells you exactly what you need to know. You don't have to necessarily know anything about the history. I can just look at the geometry. This is the unemployment rate change from a year ago in terms of percent, and it is looking sketchy as well, okay? So we see the exact same thing happening. We have this leading up to that point where it is in the positive, and I'm just showing you the correlation to what we have seen in these previous instances. Happens to be a repeating pattern, okay? So we're looking at the same data, but in two different ways. Just interesting, that's all. Average monthly private sector job growth, this has been declining over the last few years, and I've mentioned this related to the GDP and others. The more money they put in, the worse it gets. That's just the way it is. The more intervention they do, the worse off they are. They have to print more money to get the same effect. No different than an alcohol abuser, drug abuser, and so on, where they need more to get high. They need more to feel good. On Tuesday, a key U.S. factory gauge, the Institute for Supply Management's Purchasing Manager Index, these are the PMI indexes, unexpectedly contracted for the first time since 2016. All you need to know is that all of these manufacturing indexes around the world, pretty much every single one of them is declining, okay? They are contracting. Usually, they mark it at a level of 50. Anything below is a contraction. Anything above, it's growing. Right now, we are seeing things moving down, down, down. Many of them are in the contraction state. Some of them that are over have been heading down for a while, and we are watching this happening simultaneously all around the world. People need to be concerned about it because it is reality. But no need to worry because this individual here has a lot of propaganda to share, and I wanted to give that to you. If you take a step back, you see that the economy isn't in terrible shape, just like a year ago. What's clear is that the central bank isn't going anywhere, and it's going to backstop the economy. Well, thank you very much. That just reassured me, and I feel so good about it. In fact, I got the warm and fuzzies right now. Market value of negative yielding bonds as a percentage of the total outstanding. This just shows you more of the data. As often as possible, I'm giving you this. It has actually declined from the peak, but as you can see in previous instances, this is only a small decline on the way to the top. Like you could see these previous little dips that occurred just like it is right now, but seems like it will go higher and higher and higher. And my goodness, it is getting to levels that are truly, truly absurd. Now, Robert Shiller, who you might know from the Case-Shiller Index, a very, very popular individual in his own way, he had something to say at the end of this Bloomberg interview and basically said, "It wouldn't surprise me at all to see housing prices decline in the near future, accompanied by a recession." And that's coming from Shiller himself. I just wanted to bring that to you. He's not necessarily saying that there's going to be a recession, that housing prices are going to drop. He's just saying it wouldn't surprise me based on what we are seeing right now. He also likened the events that we are watching today occurring, particularly with the trade issues, saying that mirrors what we saw in the 30s. Ray Dalio has mentioned this as well. Three more things, extremely quick, need to move through this. Farm loan delinquencies surge in the U.S. election battleground, Wisconsin. We are watching farm loan delinquencies rose to a record high. Farmers are getting hurt because of what's happening today. You look at the percentages, hey, it's not that high, but if you see where it had been historically, when you get to these levels, it is very concerning, okay? So you can think to yourself, well, you know what, everyone's doing fine. If I see the credit card debt at a certain level, oil, well, then it's not a big deal because it's only a small percentage. No, it doesn't work like that. You need to study on a historical basis how this has been. And right now, this is not good for the farmers and really anybody in debt. U.S. shale firms cut budgets, staff as oil price outlook dims. It's not just because of the oil price suggesting that, hey, oil is low right now, so they're not profitable. It's extremely expensive in general to do this process, not to mention dangerous on so many levels. And here they are telling us how wonderful and energy independent they are. But look at the lengths they have to go to. If you have to maintain a certain price of oil just to be able to be profitable, something's not right about that. They are with this expectation that if we just hold on for a little while, a few years, we can actually become profitable at some point. We just have to wait until oil's at $100 a barrel and we're all good. This is not a sustainable system. Here you can see the energy bankruptcy filings on track to top 2018. We'll see what happens. Just wanted to give you that information there. Then last but not least, you could see that the previous video I had done talking about Jerome Powell saying, and I quote, "We are not part of the government." As far as I am aware, I did a search right here and it looks like I am literally the only one on the internet who ever quoted this. It's as if it never even happened. We've been waiting for admissions talking about the private Federal Reserve, and we have to get that data through these second and third level sources. We're able to bring that information together, and you could say, it's semi-private, it's quasi-government, if you look to shareholders, this and that, all that data comes together. But to actually have the admission from Jerome Powell, the Fed chair himself, saying, and I quote, "We're not part of the government," here it is, nobody else on the internet is talking about it. This just shows you how people are so distracted by all of the nonsense out there. That's why I did this video, because I know that it is so important and yet people don't know what the hell is going on. If you found this video informative, hit that thumbs up button. I'm trying to bring you the latest and greatest data. All you have to do is click one button. Less than 10% of people do that, but I hope that you will be one of those people. If you want to know how to build a business, then the Amazon GPS is what you need to get, because it's free and it teaches you step by step. This shows you all of the data that you need in order to build a business online, passive income strategies that make money while you sleep. Believe it or not, this is operational 24/7. You set it and you forget it. Check it out. It's free, theamazongps.com. If you want the financial education that you were not taught in school, well then these two books have what you need. All the data, all the details, make money, foundation, reducing your debt, all that is in these two books. Check them out at the link in the description. If you want the audiobook, that's available at themoneygps.com. If you haven't seen the video already talking about Jerome Powell saying we are not part of the government, then this is the video. Just click on it and I will see you there.